Hello, crypto geeks and new investors. This is Jaron Perlman again, aka Speak Crypto, talking today about another reason behind the birth of Bitcoin and other cryptocurrencies. I would like to speak today on the 2008 housing crisis that resulted in the largest economic crash in history and how monetary centralization enabled a heist of such massive proportions. The prospect of centralized government bailouts to private companies is of course at the root of this problem, namely that too big to fail companies know that they will not be permitted to wane from existence. Given this fact, they are able to initiate and perpetuate toxic business models, knowing full well that they will be kept afloat by U.S. taxpayer dollars and the Federal Reserve. That being said, let's have a quick overview of the practices leading up to the market crash and subsequent bailouts. Firstly, government regulations on housing loans were liberalized, meaning one didn't have to show that they could properly afford the houses that they wished to buy. Already, such a notion is troublesome because it implies that many loan participants may default and the bank or loan company will be at risk. In response to this, major loan companies began to offer derivatives to their investors. These derivatives were debt packages wherein third-party investors could buy the debt of loan owners with an advertised interest rate on top of their, quote, investment. After this, said debt package securities are purchased en masse by the banks from the loan companies. Once the inevitable homeowner defaults began to happen, the government would step in and purchase the failed debt securities from the banks at the expense of every American taxpayer. So far, here's what we have. Loan officers and bank industry personnel take commissions from the loan given to Party A, the mortgage owner, and commission from the loan to Party B, the derivative investor. Now, when Party A defaults on their subprime loan, Party B will be the one that lost their investment and not the bank or the loan company. From even the most simple perspective, this model was designed to fail, allowing only commission takers to profit. This entire paradigm is subject to scrutiny on the public level, as the removal of loan regulations was kicked off by former bankers and loan officers turned politicians. Suffice to say, there is definite moral hazard with such a career alteration. Cryptocurrency was designed specifically to combat unilateral central decisions regarding the public's money. By bailing out bad businesses, the Federal Reserve and the U.S. Treasury lowers the worth of the dollar and directly harms the U.S. economy. By creating a peer-to-peer decentralized currency, these pitfalls may be avoided and prevent government subsidy of toxic business. The creation of Bitcoin 1 year later in 2009 was no coincidence. I hope you enjoyed this short breakdown. If so, follow @SpeakCrypto on Instagram, Twitter, or Facebook. This is Jaron Perlman, signing off.